All right, listen up because this is important. When you think about the titans of Wall Street, you have to talk about Moody's Corporation, or MCO. They are the ultimate arbiters of creditworthiness. Think of them as the financial world's most trusted referee. Companies, governments, complex mortgage-backed securities, they all line up to get a grade from Moody's. This grade tells investors one crucial thing. How likely is it that you're going to get your money back? It's the bedrock of trust that allows the gears of global finance to turn smoothly. Without Moody's, the system gets shaky. Imagine lending to a company you've never heard of in a country you can't find on a map. You'd be flying blind. That's where Moody's steps in. Their ratings from AAA to mid-range down to C provide a universal language for risk. This isn't just nice to have, it's essential. It dictates interest rates and influences investment decisions. It's a pillar of the modern economy. The company is split into two main powerhouses, Moody's Investor Service and Moody's Analytics, the perfect 1-2 punch. Steady, reliable ratings plus forward-looking analytics. Stability and growth, a name you need to know. It's the bedrock of financial trust, and that trust is the backbone of global markets. Now let's get down to brass tacks. The story is in the numbers, and Moody's numbers are singing a beautiful tune. When we look at the full-year results for 2024, the company pulled in a whopping $6.2 billion in revenue. That's a solid 8% increase from the previous year. Now revenue is great, but what about the bottom line? Moody's reported a diluted earnings per share of $10.55 for the year. That's the kind of number that makes you sit up and pay attention. Let's break it down further. The Moody's Investors Service Ratings business is a cash cow, a high-margin machine. When debt issuance is strong, this part absolutely crushes it. But the real star lately has been Moody's Analytics. This segment brought in over $2.8 billion in revenue, showcasing consistent high single-digit growth. Companies are desperate for data for risk management tools, and Moody's delivers. Looking at the most recent quarter, the second quarter of 2025, the momentum continues. The company posted revenue of $1.6 billion, beating Wall Street expectations. The demand for their ratings and analytics is relentless. This isn't a fluke, it's a trend. Let's talk about my favorite subject, getting paid. A great company doesn't just grow, it shares the wealth with its stockholders. Moody's is a dividend-paying machine. As of our latest data in mid-2025, Moody's is paying a quarterly dividend of 85 cents per share. You do the math, $3.40 per share annually, cash in your pocket, a reward for ownership. Some might look at the dividend yield, which is hovering around 0.8%, and say that's not a huge yield. They're right, but they're missing the bigger picture. You don't buy Moody's for a high starting yield. You buy it for dividend growth. This company has been consistently raising its dividend year after year after year. In 2022, the quarterly dividend was 70 cents. Today, it's 85 cents. Roughly a 21% increase in just a couple of years. They've increased their dividend for 14 consecutive years. Through market crashes, slowdowns, global pandemics, Moody's kept raising its payout. Their dividend payout ratio is typically in the 25 to 30% range. A conservative, sustainable level, that's the sweet spot, rewarding shareholders while retaining cash for growth. They reinvest in the business, make smart acquisitions, and return cash via dividends and buybacks. It's a virtuous cycle of value creation. This is a dividend story you can believe in. So, we know Moody's has a great dividend growth story. But how does it stack up against the competition? Let's put it in the ring with other financial heavyweights. A big bank like JP Chase, they might offer a higher starting yield, but their business is far more cyclical and exposed to credit losses. They just can't match the consistency and quality of Moody's business model. Let's look at S&P Global, the other half of the ratings duopoly. They also have a fantastic dividend growth record. You wouldn't go wrong owning them either. But in the 5-year dividend growth metric, Moody's has often grown in the double digits, roughly 12 to 13% per year on average. Moody's operates a toll booth business. If a company wants to issue debt, it often pays to get rated. That creates predictable, high-margin recurring revenue, which allows management to plan 5 to 10 years out and confidently increase dividends. This financial fortress lets it compound dividends faster than many peers. When choosing a dividend horse, ask yourself, Higher yield today with more uncertainty, or lower starting yield with double-digit growth? For my money, I'm betting on the growth. I'm betting on Moody's. So why should you own a piece of this company? Let me spell it out for you. First, the moat. Moody's has one of the widest moats you'll ever find, operating in a duopoly with S&P Global. Breaking into ratings and earning regulatory trust would take decades and billions. That lack of competition gives pricing power and protects profits. Second, the nature of the business. Incredibly stable and non-cyclical. In economic uncertainty, demand for Moody's analytics products actually increases. Companies need data to navigate the storm. An all-weather stock, a foundation for any serious portfolio. Third, management and execution. Leadership has evolved the business and invested in analytics. The expansion of Moody's Analytics is a strategic masterstroke, nearly half the company's revenue now. That shows foresight and long-term value focus. Finally, asset light. No massive factories or inventories. Main assets are brand, reputation, and analysts' expertise. That translates to incredible free cash flow, a cash printing machine. They reinvest, make smart acquisitions, and return capital via dividends and buybacks. It's a virtuous cycle of value creation. Bottom line, it's a buy. So what does the future hold for Moody's? I see a clear path to continued growth. First, global expansion of capital markets. Emerging Asia, Latin America, Africa will need to issue debt to fund growth. Every issuance needs ratings. Moody's is positioned to capture that wave. Another tailwind. Increasing complexity of finance, structured finance, derivatives, new asset classes. New asset classes create new demand for ratings and analytics. The rise of ESG investing creates new risks to be rated across environmental, social, and governance areas. Companies will need Moody's expertise to navigate these new landscapes. That means new product lines and revenue for both ratings and analytics. They're on the cutting edge of financial innovation. Of course, no investment is without risk. Biggest, regulatory pressure. They're under the microscope worldwide. Major rule changes could impact their business model. Another risk, a prolonged global recession that halts debt issuance. Analytics provides a buffer, but a deep freeze would hurt earnings. Weighing risks against strengths, the scales tip in Moody's favor. Duopolistic market structure, secular growth in data analytics, and expanding global finance provide multi-decade tailwinds. For the patient, long-term investor, Moody's is a chance to own essential plumbing of global finance. Don't miss out.